Guys. Thank you for joining today. We'll give it a couple minutes before, while people finish up getting getting in and connected. I'll just give it a couple minutes here uh, and just make sure that we're fine with our screen. Cool. So let's get it started. I think we'll probably start seeing a couple more people joining as we go, but just to make sure we're on time here. Again, thank you for joining. I'm already sharing my screen. The whole purpose of today's webinar is maybe a couple of ideas here. First of all, just refresh some information about Apex Infinity Fund, and if you have been maybe like following some of our emails and newsletters and whatnot, we've made some adjustments to the, let's call it, tiers of investment depending on the invested amount as well as their returns. So just wanted to take some time to refresh that information, and now that we're here, maybe go over some of the main points of the fund, as well as share some updates and news of what has been happening in the past few weeks, actually a couple of months since last time we set up one of these. So, if you guys have been with us before or long enough, probably some of this will be a little bit of a repeat, but bear with us. Still, we believe it's relevant information and worth taking some time to reiterate and maybe just refresh again. So, going back to our management and who's part of Apex and in front of what we're doing these days. Combined experience of more than 25 years at this point. My business partner, Daniel Gonzalez, who's not with us today, but he's basically in charge of asset management and acquisitions for our side. On my end, I'm leading our finance efforts. That includes corporate finance and capital markets, equity raising, and investor relations, and all that good stuff. And then, really important, and it's something that we keep relying on and growing as we go, is our team. I would describe it as a three-legged stool as our main characteristics here, with our finance team being one of those, our investments team, and our construction team. So we try to do as much as we can in-house, except for property management at this point, since we have a good ally there with the management of our properties and our units. But in terms of finance, everything that has to do with, as I already mentioned, structuring deals, structuring our capital stacks, debt, equity, and whatnot, we manage in-house with our team, which is, and as we will also describe a little bit in more depth in a minute, is split between our home country, Colombia, specifically in Medellin, and here in Atlanta, our I guess like our hometown at this point. Also, on the construction side, it's something that we keep growing and evolving on. Today, it is a key component of what we've been working on specifically for Apex Infinity Fund, which relies a lot on development. So we have our development team, pre-construction and supply chain team, as well as our construction and renovation teams. Obviously, there's a lot more people on the ground now that we have more volume going on. But part of that backbone is still in Colombia, helping navigate and orchestrate the different tasks that happen on a daily basis. As far as our, let's call it our competitive advantage, there's a few things that I would want to highlight here and reiterate on. One is we're based and investing in Georgia, specifically in Metro Atlanta, or as close as we can from Metro Atlanta. One of our mantras and what we really believe on is being close to the asset and not being like an out-of-state kind of manager or investor. For us, being boots on the ground and having people at most 2 hours from each of the properties makes a lot of sense, especially on the operational side. And then also on the construction and development side, obviously makes a lot of sense also. So staying true to that Georgia approach, at least for now, as we always say, we get a lot of questions around that if we're thinking only in Georgia moving forward and down the road, but probably that will change at some point. For now, we do believe the fundamentals, knowing the market, being close to the asset is something that adds value, and that's one of the reasons why we're here. As far as why Georgia, we believe its location strategically located for the east and southeast, and even if we look at it out more general scheme, it also makes sense. Multiple industries, businesses, jobs, and job growth, population growth. Obviously, not different than the rest of the Southeast, but Atlanta and Metro Atlanta has been being part of that growth in the past few years, as probably you guys know. Just a few metrics there. 2023, more than 100,000 people were added to Georgia, and specifically to Metro Atlanta, more than 60,000 people, which still, I guess, supports that thesis of staying in growth markets and where we see solid fundamentals. Now, when we break it down to our different departments and groups, I would highlight what I already mentioned about acquisitions and asset management being boots on the ground market. It allows us to have a lot more market knowledge and sourcing capabilities. As far as our finance team, just keeping lender relationships, not that we work only with local groups, but for lenders themselves, knowing that we are close to the asset and really know our market adds also value and allows us to do like repeat business with them. It allows us to have really strong structuring capabilities and a dedicated team for investor relations, which we believe also makes sense. It's part of what we believe on, just making sure we can respond to investors, respond to any of our stakeholders in the shortest amount of time possible, and being there for any questions, any feedback or comments. And then on the project management team, the fact that we have a solid team both locally and supporting the operation, it allows us to have in-house permitting, expediting, construction and supply chain under control, as well as a good access to subcontractors and trying to skip as much as we can those middlemen and which at the end of the day translates in cost savings at least as much as we can. And then our team in Colombia, which already mentioned couple slides back, but just kind of like to double click on it. It just allows us to have additional manpower, a professional team dedicated to specific tasks, and try to keep as few hats per person as possible, especially as we continue to grow. It allows us to have enhanced operation capabilities, and the offshore professional and bilingual talent adds efficiency to our operation, definitely. Mm, Moving on to our, I guess, like the main objective of our firm, and to speak a little bit about our track record. So, if we look at it from a total portfolio, including properties that we have already full cycled or sold, as well as what we currently own and currently have in our portfolio, we're getting close, and I think past the 500 units between properties that we have owned, renovated and sold, renovated and held for rent and then sold, and as well as multifamily units that we have held. That adds up to somewhere along the lines of $80 million in assets under management. And we've surpassed the 20 million mark in equity raised and managed, right? When we split that between what we have already full cycled and owned currently, I would say, as you can see on the slide, we're somewhere along the lines of $60 million under management. That's split between multifamily, about 70% of our portfolio, and 27% of that is single family. On the single family side, we're getting back from our original approach of buying existing properties and renovating. Now we're focusing a lot more on development and new construction, both for sale and for rent. And then on the sold assets or full cycled assets, we're somewhere along the lines of $20 million. 85% of that was single family. As probably most of you guys know, that's where we started. We did a lot of buying distressed properties, renovating and selling. We held a single family portfolio at some point, and that was fully cycled between 21 and 22. And that's basically what we've done as far as like track record. So just to summarize it in a few words, basically that initial steps within the single family space, buying existing properties, renovating, whether it was for sale or for rent, our transition into multifamily value add approach, acquiring existing properties, and then getting back to single family with a more of a development and new construction approach, also for rent or for sale, and then staying in that kind of like dual track of single family ground up and multifamily existing product with a value add component. As you all know, the past couple of years have been a little bit lighter on the pipeline perspective, just being a little bit more challenging to find interesting opportunities, but we keep our eyes open and our team underwriting constantly to make sure we can take opportunities as they come. Moving on to what we call, let's say, like our investment strategy, and this would be specifically for Apex Infinity Fund, which, as you probably already know, it's a commingled fund, open-ended fund, looking to offer fixed return to the investors. We'll talk about that in just a minute, but just getting back to what is it that we've been working on and what we're seeing moving forward in terms of what kind of verticals will we be implementing for the fund. So on one side, as I already mentioned, the BTS approach, which is just new construction for sale. So this is one example, the one that we see here, top left corner. The project, we called it New Co-Coming. It was a lot that we subdivided into 3 specific parcels. We developed the homes and sold. That's home building to the retail market. Great execution there with a very interesting IRR in a pretty short time frame. Then on the multifamily side, just to give you guys one example, is our Polaris at Cumming, which we acquired in 2020, sold in 2023, with a pretty much a textbook value add approach of renovating the units, getting the rents up where we needed them, and operating thereafter. On the BTR side, it's, we used to do a lot of this from existing product. Now we're implementing the same thesis, but building ground up. We had a rental portfolio, as I mentioned, between 2018 and 2021. We sold in 2023 with a good return also. And then basically what we're trying to do in Apex Infinity Fund is just replicating the same thing with these verticals. As far as hard money lending, what we're trying to look for here is based on our experience underwriting, our experience being borrowers of these kind of loans, just opening up this fourth vertical at some point, probably later this year or more so early 2026, to offer lending opportunities for other investors out there. Just understanding that with our experience and our track record in this space, we can just add a new component and a new vertical within the existing fund. As far as the business plan for Apex Infinity Fund, just a few highlights here. As I mentioned, this is a fund that will offer investors the opportunity to be part of a diversified portfolio, but still have a stable income or a stable profit and appreciation via inflation hedging, diversification, and obviously our professional management. What we're looking to do here is, as I mentioned, offer fixed returns rather than going into specific deals with a targeted or projected IRR and having to wait until the property or the project is fully cycled. Within the fund, there's a lot more flexibility to go in and out. We're going to talk about that in just a minute. That hasn't changed. That's staying the same. Again, as I mentioned in the first few minutes of the conversation, what we're looking to elaborate on here is how the investment tiers have been modified to your benefit, actually. So in terms of the four verticals that we already discussed, with BTS or build to sell, what we're looking is making decisions based on data and our experience with the dedicated team and our in-house efforts to make sure we can process efficiently. In the multifamily space is making sure we can find those interesting acquisition opportunities and then use strategic financing structures where we can execute business plans, just as the one I described on the slide, previous slide. And on the BTR side, it'll be a run starting at executing new construction for rent on a scattered approach. So buying individual lots and trying to combine them into a portfolio, and then later on being able to get into more of a community approach where we will be buying or acquiring lots to subdivide or already subdivided lots, so that we can create smaller communities to be managed with a rental approach. And very similar, as already mentioned, for the hard money lending or private lending, it'll be just offering loans to other investors with fix and flip approaches or ground up construction, just relying on our experience and what we have done in the past, just pretty much just sitting more of on a lender position to give it a lot more liquidity and shorter term returns for the fund. Now, getting into the returns in the share classes, and I think this is where it all really happens, and happy to elaborate a little bit more here. Since last time we had this presentation, we were talking about three classes with the tiers a lot wider. So for those that recall, there was a in the range after the $100,000, it went all the way up to the $1 million, and then these three would be combined in one single tier. What we decided to do is, in order to give it a lot more options for those investors that are growing within the fund, just being able to offer better returns with tiers in between. So I'll just go over that in just a minute. In general terms, once again, the fund offers flexibility and caters different investment goals. So depending on whether you have a lot more to invest or just have a longer time period or a shorter time period, as well as if there's distributions required or not, if you want to compound or not. So we'll just go into that in just a second. So first off, the share classes. So we're talking about 5 share classes starting at more than $1 million. Now, we used to have a 9.5 return. Now it's a 10% return. So north of $1 million, return of 10% yearly fixed. And then going down the line there, Class B would be anywhere between 700 and 999, so to speak, or shy of $1 million. Return would be at a 9%. Class C would be between 400 to that 700 mark at 8.5%, and 100,000 to 400,000 at 8%. And then we still have the option for those that, and I mentioned this just because our minimum investment amount used to be 100,000, so that's why we opened this final class with Class E, which starts at $25,000 up to that 100,000 to get your feet wet and get started at a 7% fixed. In terms of the distribution options, those haven't changed. It's the same thing. We have the 2 options, either the total growth, which is basically maximum growth model with no distributions, still has the bi-yearly compounding feature, but it'll compound until the funds are redeemed or withdrawn. And the other option is the growth and income, which is a balanced growth model, which has half or 50% of that profit will be distributed bi-yearly in August and February, and the other 50% of the profit will be compounded in your account. Another important thing that I would like to highlight here is we're already implementing our software or platform investment management platform, which will be available probably in the next few weeks. That way, it'll be a lot smoother in terms of distributions, onboarding, following up with your investment, what has been distributed, what will be accrued, as well as compounded. It'll give you guys a lot more options in terms of options and visibility, I would say, just to make sure you can keep track of your investment in a lot smoother way. Once again, that's being implemented as we speak. A few weeks while we have it up and running, but this is another feature we wanted to highlight today. One thing that we had this also before in the slides, but something that we think it's worth spending a few minutes is, and it's also based on some questions that we usually get from investors. And it's like, okay, so how do I compare this investment with other comparable investments? And obviously, I know a lot of you guys get pitched a lot of investments, from different asset classes, but even within the real estate world, you get a lot of opportunities out there with the typical LP GP structure, whether it's acquisition for renovation, whether it's ground up development, whatever it is. In this case, what we're trying to do, and I'd like to really keen on that, is keeping a diversified portfolio and offering a fixed return, which is different than when you go to or invest in a debt fund that's also exposed to potential default. In this case, it's a fixed return. And in our opinion, it's really comparable to either the ones that we have here. Obviously, there's other options or other alternatives, but just to highlight some of them, preferred stocks, bonds, CDs, treasury bonds, money market accounts, and stuff like that, high yield accounts. So in today's market, we're seeing these, in the best case, offering less than 5% yearly, in some cases even less than 4%. So that's where we really believe it's comparable. And as you can see, there's a delta created between any of those options and what we're offering in this case. Happy to go over this in a lot more detail, but in essence, what we're trying to figure out here for investors is a way, even with both of the options in terms of distributions, a way to compound and try to get to that double digit as fast as you can, or still have some distribution, but also have the compounding effect, and pretty much get like the valuation and the dividend, so to speak, as you go. Moving on to this next slide, this is something we wanted to highlight also. It's just a little bit more visual and easier to follow, and it's kind of like a comparative overview. I won't spend a lot of time on this one. We'll definitely share the slides with you guys as well as the recording, so you can follow up on these. And we're just comparing Apex Infinity Fund to other alternatives different than the ones that we mentioned on the previous slide, but this one's like comparing to traditional real estate funds, those that don't have specific or fixed returns. Private debt funds and private equity funds, also happy to elaborate on these. These are conversations that we constantly have with investors just to make sure that we're aligned. It doesn't mean that there's a better or a worse opportunity out there. It's just different characteristics, and it all depends on what the expectations are from both sides. And on our side, it's just we're really truly focusing on equity and wealth preservation and making sure that we can keep up with inflation and obviously offer a competitive enough return for it to be appealing and compelling to investors. Moving on here to our key investment drivers. So there's some things that we just like to highlight here in general terms. One is like the key elements of Apex Infinity, and just to make sure we can, I guess, make sure we put it out there clearly. And one is the low minimum investments. And what I mean by that is just that option and capability of getting in with only $25,000. A lot of the times you see in other opportunities where it starts at 50,000, 100,000, even in our case, it used to be 100,000. Here, there's that opportunity of getting in at a lower amount. Flexibility, and what this means specifically for Apex Infinity Fund, and we'll discuss it in the next slide also, is just the fact that since investors are not in the equity position but more on the creditor position, it allows us and investors to have a lot more flexibility to get in and out of the fund if necessary. Obviously, we love it when investors stay long and stay with us and really get value out of our investments. But life happens. A lot of the time is kids go to school, or there's some kind of traveling need, or whatever the fact it can be. Our lockup period is only 18 months. After that, there's a lot more flexibility for investors to get out whenever they need it. Consistency, and this is just pure structuring of that was like the main driver of us putting this together, is making sure we can have consistent, reliable distributions as we go, and then which is obviously translated in a lower risk, just because you're not waiting for a potential return that has been projected. It's more, this is the return I'm getting, and we're just making sure that we have the low enough leverage and enough transactionality happening so that we can comply with the returns offered. And then the other side is the power of compounding. A lot of the times we get questions like, well, but we're seeing mid-teens returns or mid-teens IRRs projected in this other offering that I'm seeing or in this other opportunity. And that all makes sense, but those are all variable. These are fixed. That's where I like to balance it out. Sometimes even investors, put some of their money to work in those kind of investments, and for some of their investments that they want to be a little bit safer, they go our route. But still, with the compounding effect, whether you go with the total growth or growth in income, the longer the investment stays, the higher the annual yield. And I think the best way to see it is in this chart that we have here, the table that we've put together. We just used a few holding periods, 3 years, 5 years, and 10 years. Doesn't mean that you have to stay that long, but just to give it an idea. And for those conversations where some investors ask, well, but you're in the single digits. What happens if I'm seeing other returns elsewhere or whatnot? The compounding effect really, really impacts your return here to the point where if you go total growth, whether it's in the 3 year, 5 year, 10 year examples, you can get to those double digits even if you keep your investment at that 25%. So if that's one of your concerns, and we can go on specifics on a case by case scenario, even if you're thinking of different hold periods, different amounts, however it is, we have even a calculator that we'll put out there for you guys to play with. But the whole point is understanding, depending on your needs and your capabilities, where that would be. I just think it's a great balance between risk and return, understanding that it's a diversified investment and a professionally managed one. And just skipping down to probably what the end of our conversation today will be, but just kind of like to summarize and make sure we covered it all. On one side, we have the objective of the fund, as already mentioned. This fund aims to provide investors with a fixed return, being reliable through a diversified real estate portfolio, leveraging multiple asset classes. I mentioned single family, multifamily, within the single family space for sale and for rent, just making sure that we keep it spread out, both on scattered approach as well as communities. And just looking to minimize risk as much as we can while ensuring a consistent return to you guys. It's a Regulation D 506C. This is the way we have structured it, which is targeted to accredited investors. It's an open-ended fund. We will have quarterly reports. First one coming up here soon. As you guys know, we launched earlier this year. And then the minimum investment being $25,000. After that, you can add $5,000 at a time subsequent. No, I guess no need to go 25 at a time. You can add 5,000 at a time. There's no fees, no management fees or any kind of fees for the fund. And then the lockup period, as I mentioned, it's only an 18-month period. After that, it's just a communication. We'll get it, if needed, a 6-month notice, and we'll get it done. As far as distributions are compounded, it's bi-yearly, so twice a year, as I already mentioned, February 28th, August 31st. And then as far as like tax reporting, we sometimes get that question. What is it that investors get on a yearly basis for tax purposes? And it's a 1099 INT. Happy to further discuss that if there's any questions on the tax side. And just a refresh of the different classes here. It's basically, as I mentioned, open up the tiers a little bit more, just to make sure there was a more chances of getting higher returns as you evolve within the fund itself. Great. And as far as getting in touch with us, I think this is also really important for those that haven't gone to our website, apexinfinityfund.us. You'll find all this information. Happy to share the deck itself and hop on a call specifically whenever needed. In LinkedIn, you can follow us also, Apex Development Group ADG, and Facebook as well. And then directly via email to me or Manuela, who runs our investor relations group. We'll be happy to answer any questions, any comments, any feedback, and make sure there's a smooth process to getting you guys onboarded and rolling on Apex. I don't know if there's any questions, any comments. Happy to interact here with you guys. We'll give it a couple minutes. I think we had some questions up here. I'll pull them up. Sorry. Perfect. So I'll go here over the questions that we've received from the folks that are with us today. As far as one of the questions is the fund eligible for IRA or self-directed IRA investments? Yes, for sure. We've done this in the past. We have it currently with some investors in the fund. So whenever if it's new for you guys, the self-directing, we can help you guys either connect with custodians that we've worked with in the past, or if you already have your accounts, happy to engage with them and walk through. For the most part, it's very easy and simple. They know what they're doing, and it's and we can walk through it. But it's perfectly fine for us with that. Another question is, what factors should an investor consider when choosing between the total growth and income options? That's a great question. And as I briefly mentioned earlier, it all depends on your specific needs. The way I see it is, for somebody that just wants to focus on growth and basically doesn't really need or wants to have some kind of return during the tenure of the investment and just focus on that return, maybe the total growth makes more sense. For those that would like to have some kind of, how they call it, mailbox money, whether it is because they have some payments within the year and that they would like to take care of from that investment, then the growth and income option it's a great opportunity. What we try to look for here is give alternatives, still making sure that there is some kind of compounding so that at the end, your investment, whenever it's withdrawn fully or whenever you would like your investment back, there is some kind of valuation within the period. Great. We have another question here. How do you ensure liquidity for redemptions in an evergreen real estate fund structure? That's a great question, and there's a few ways we've done it. And I'll start from what we believe is more of a structural reason, and it's the different verticals that we have implemented for the fund. So as you see from what I've said and I've mentioned, we have what we call BTS, or built to sell, which is more like a home building approach. Then we have the BTR, which is built to rent and hold for a period of time. Multifamily, which is also rent for a period of time, and then private loans or hard money loans, or however you want to call them. The first and the fourth are usually shorter time frame investments, which gives us a lot more transactionality. So on average, a home between breaking ground and selling takes somewhere along the lines of 12 to 13 months. So every 12 to 13 months, we get some of that cycling with a profit, with some return, and it just allows us to have capital events, whether it is a lot of volume or not a lot of volume, but it just gives us that liquidity. That is from an operational standpoint. Now, from a structuring and capital stack standpoint, what we do is we keep our senior loans at a low leverage, just making sure we don't have a too high of a debt service requirement, and making sure we can keep from the second vertical, which is BTR, and the multifamily approach, we can keep some of those funds or monthly payments and monthly cash flow. We can keep it liquid for any of those events, whether it is for distributions per se, or redemptions of investors that are cycling out of the fund. Those are pretty much the two ways that we cover for that. Last one, there's a comment here. Hello, Donnie, congrats for the fund. I have a question. How do you project consistent returns across different asset classes with very different risk profiles and cycles? So it's similar to the past question, which referred to like keeping liquidity in the fund. As far as like returns, I think the best answer to that is we are focused on a market that we already know, and making sure that we're not focusing on volume but quality. So we've narrowed down specifically which are the markets and the sub-markets and the type of properties that work in these specific markets, and making sure we can keep long-term investments and short-term investments to keep that machine churning, so to speak. That's the way we make sure profits and returns are available. And then we combine that with the liquidity portion that we keep at hand to make sure we can comply with any requirements, whether it is for distributions or for redemptions per se. That's I think that's a wrap from the questions that we've had. Let me just double check here. Yeah, that'll be it for this time. Once again, I really appreciate anyone and everyone that joined, that spent the time. I know this is usually taking an hour from your schedules is not easy. Thank you so much for joining, and happy to have these kind of conversations. Happy to reconnect offline whenever needed, answer any questions, and hopefully have you guys on board very soon. Thanks again.